So kind of my plan with these is I'm just going to kind of casually just go through the slides. It's not going to be as like polished as I'm sure the YouTube videos are, because those take me about 500 takes to do those. As I go through the slides and explain, kind of what they're about, what the ideas and the concepts are behind them. If you guys want to just take note of any questions that you have about those slides, and then we'll open it up at the end to do some Q&A on those. And that's kind of what I want to do, because I don't really necessarily just want to go through the slides again, like I did on YouTube. I want to see what questions they spur on for you guys regarding the methodology, things like that. Cool. So that all being said, so let's go ahead and kick this thing off. So the 4 pillars of trading mastery is what we're going to be covering throughout the series here. And in those 4 pillars, we're talking about the game, the master pattern, time frame analysis, and market psychology. And then we're going to have different levels of understanding. We have a level 1 understanding. So the way these work is it's basically level 1 is going to be a more basic overview of these 4 pillars. Then we're going to go level 2, level 3. So this is going to be the first one. The first lesson that we're actually doing today is going to be the bank's business accumulation distribution. Then next week we'll go to master pattern overview. Week after that we'll go to intro to multi-time frame analysis, directional bias. And then market psychology, we'll go into intro to pain and pleasure theory, why traders lose. And then after that, we're going to go into level 2, conflicts of interest, contraction, the beginning of everything, round trips and market stability, and relationship between pain and certainty of liquidity. And then level 3 is going to be become the observer of the game, the master pattern advanced theory, time frame forecasting, speed of money flow, and engineering your success. That all being said, let's go ahead and kick it off to lesson 1, the bank's business accumulation distribution, level 1, the game. And so this lesson is really about understanding how the bank manages inventory. That's the biggest takeaway that we're going to get from this, is understanding how they treat their business and how they accumulate inventory to distribute that for a profit. And the idea is mirroring what they do and thinking from their perspective. So I'm going to just preface the lesson with that. So you want to think of a normal business in your neighborhood that sells goods of any type. That's kind of the mind space you want to get in. That business will try to accumulate their goods at the lowest prices possible. When the crowds walk by and come into their store, the business will try to sell them their goods at a much higher price, thus creating a profit for the business. The bank's business model is the same as any other business. You're gonna want to buy stuff or get inventory. You're gonna want to display that inventory in hopes that people are going to want to come and buy it off you, and that you'll be able to mark it up and make a profit. When the bank accumulates positions, meaning whether it's from market making activity or proprietary trading, the goal is to make a profit on those positions, more so in proprietary trading, because they're actually betting on distance that the market's going to travel, right? So with market making, it's the same thing. Some of that market making business can spill over into their proprietary trading as well. But the idea is to make a margin or make a profit on any inventory that they deal with. The market making, they have the spread baked in. That's much more of a volume business. Proprietary trading, not so much. So keep that in mind. They're trying to, anytime they're accumulating positions, the goal is to make a profit on those. Why is understanding accumulation distribution important? Just like other businesses operating in the financial markets, it is the business of buying and selling things for profit. The difference in the financial markets is 95% of businesses cannot make a profit. And this is important that you learn and follow the business plan of the 5% who consistently accumulate and sell their inventory for profit. So again, just to kind of reiterate what we're talking about here, is that if the banks are accumulating inventory to distribute that inventory for a profit, they have a process of doing that. And since the banks are the only ones at the end of the day that really influence the market movement, especially in Forex, it's not necessarily true in like low cap stocks and things, smaller markets like that. like we saw with the GameStop situation, that move was propelled by retail buying. They actually overcame the hedge funds and pushed the price up like crazy. So yes, the retail public can have influence, but when it comes to Forex or these bigger, more liquid markets, the only people that are going to move these is going to be the banks and the institutions. They're the only ones trading the most size. So we really want to get in their headspace of how they're doing that business, how they accumulate their inventory, and how they make a profit on that. Because at the end of the day, we're not moving the market. We can't manipulate it. We really essentially can't influence it. The banks can influence it not only through their buying and selling, actually like putting volume or supply, adding supply to the market, or creating their own demand, or they have their own demand, but they can also influence the news. They could create co-ops with other banks, which gets into pretty shady territory, but they can do that, and they do that, and they get fined for it regularly. You know, this is not new. They pay fines regularly for market manipulation, and those slap on the wrist, I think they just consider it as the cost of doing business, because every billion they get fined, they probably made 100 billion in profit. So that's the way it goes around. So anyway, we definitely want to get in their space and in their headspace and understand how they're doing business. So let's keep going here. So at the end of the day, successful predictions make successful trading. We're trying to figure out, where is this thing likely to go? Of course, we don't know exactly where it's going to go, but we can come up with some educated guess that's pretty good. And then we can, as you guys know, we look for clues that narrative is starting to play out. The narrative or the view that we've adopted of the markets, we look for clues that that's starting to happen. So to best understand how to predict future prices, you must first ask, who has the power to move price? Why do they move price? And how do they move price? These are the three questions that we want to answer and figure out, right? So who? And again, we've already kind of got into this, but the banks. Market making and proprietary trading are the activities that they influence price with when it comes to actually interacting in the market. That's their two main streams of business in actually doing transactions in the market. When I say the banks, that's a kind of a blanket term for institutional money. Okay? The investment banks are the big ones, but there are also big hedge funds. There are also other entities, but we just say the banks as a blanket statement to talk about the smart money at the top. Okay? So it's not necessarily like it's going to be JP Morgan or it's going to be Goldman Sachs. They're definitely involved, but it's going to be the accumulation of the banks that have the power to do this. So now the question is, why? I'm not going to get too conspiratorial on this, obviously. It's not what we're here for. But if we look at the history of the world, why do the banks do anything that they do? It's for profit. And ultimately, if you look at that, the profit that they make ends up getting them a lot of control in the world economies. They're able to contribute to their political campaigns of their choice, probably who's ever going to give them the most favorable treatment, and implement policies that they benefit from, things like that. We would be lying to ourselves to say that that is not part of the motivation for what they do. After you make so much money, after you have, $1 billion or $100 billion, from a quality of life standpoint, even for the people at the top, it doesn't really get much better. In fact, once you meet your basic expenses and you know that you're not having to figure out how to pay for your next meal or how to keep your home or a roof over your head or keep your car or the basic luxuries of life, or basic necessities, I should say, outside of that, it kind of becomes a game. We want security, we want those types of things. So there's a range in there, but after that, you start getting motivated a lot by just playing the game. And at these levels, a lot of it is motivated by control. It's who can they control, the politicians they can control, things like that. That's why they do what they do. It's why they are manipulating markets. It's why they're putting so much effort into this business to make the most amount of money is a profit and control. So just to illustrate this, if you guys look at the earnings of Goldman Sachs, they reported $11.3 billion in profit in 2022, and this is mainly due to investment banking, market making, and proprietary trading activities. Those are their three main profit sources. And a lot of that was proprietary trading. Goldman Sachs is known for proprietary trading. So it gives you some insight into where the money is being generated. So let's talk about accumulation distribution on a basic level. So through the business of accumulation distribution, while manipulating the supply and demand, this is how they make their profit. So we have the bank here. We could see the price action is trading lower than what we'll call value, where it says accumulate supply, and the green dots they represent the bank's accumulating inventory. You'll notice that they're all on ticks down. You'll notice that the market is starting to come down, and we put a green dot there. That's on purpose, because when you see the market spike down, a lot of times retail traders especially are going to chase those because they're thinking that we're potentially in a downtrend, and they're waiting for confirmation. They're waiting for the market to actually move, and then they jump in and chase it. So we see those aggressive moves that happened on the push down, and I specifically put the green dots there to represent that when other people are chasing the market, typically the banks are doing the opposite. So they're accumulating supply. As those retail traders are selling the market, that creates the opportunity to do the opposite from the bank's standpoint. So they're able to buy the other side of those sell orders. And it's not necessarily, we'll get into this later in this course, but it's not necessarily just retail traders. You'll hear us talk about smart money. You'll hear us talk about dumb money. Even smart money can be dumb. Okay, there's different levels and there's a different spectrum across the board. Okay, so it's not necessarily this is all just mom and pop retail traders sitting here and the bank's just taking money. It is a lot of that, but there's also less sophisticated institutions, lower level hedge funds, different people that are also making the wrong decision, and the best ones are going to come out on top. So keep that in mind. It's not necessarily only retail traders. So the bank accumulates buy inventory from willing sellers, and then the market goes back up through value, and that's where they distribute into the rising demand for profit. So the bank sells its buy inventory for profit to willing buyers. Now the market's going up. Notice that the red dots are at the top of these moves. As the trend continues to break out, move to higher highs, you have people increasingly chasing it. And that becomes the exit liquidity. Now, another thing worth talking about right now is news releases. A lot of times when you're coming up to a planned news release, I should say, when you're coming up to that, usually you'll get some market movement already. And it'll either start trending up or trending down. Maybe it has been for a week or a few weeks up to that big news announcement. That is what's getting baked into the market because people have generally the same expectation of what the news is going to be. It's not super hard to predict these things. What ends up happening is when the news comes out, that ends up spiking the market usually in a completely opposite direction. When the news comes out, that's creating the exit liquidity for the banks because the move's already been priced in. So keep that in mind. If you ever have a situation where you're trying to understand why the news did what it did and it went a completely opposite direction, it's because it's already been baked in and there's no one else left to get in. So it's going to go the complete opposite direction as everyone tries to unwind positions. And again, it's usually creating the exit liquidity for the banks. All right, so we're going to talk about the trader's business. This is just another illustration of how this happens. Again, I know you guys in this group this is pretty elementary things for you guys, but let's just go through this just so anyone watching this will be able to get their head around these concepts. So we have a seller here that's coming to the market, and his opinion is a bull runs over. I want to sell 100 shares for $1,000. So that's what he's thinking at this point. So we got another guy that comes in here. This is you. You can put yourself in this position. I think there will be more buyers at higher prices. I'll buy your shares for $1,000. So he says, I'll come along and I'll buy your shares for $1,000. This is the agreement that needs to happen in order for that seller to get out of his position and for that buyer, which is you in that position at this point, to make that transaction. Notice there's two different opinions here. One person thinks that the run's over. The other one thinks, no, it still has some life left. So that's where the transaction is going to be made, right? Okay, now we got another buyer that comes in. The stock is going to the moon. I need 100 more shares. So he already has shares, but he wants to buy another 100. Notice we're just dealing with this 100 shares and how it's transferring across people. Now you as a trader says, I'll sell you 100 shares for 1,500, meaning the price has gone up and now you're seeing, let's say, a $500 profit, right? Just keeping it real basic. So he says, I'll sell you my 100 shares. This trader says, done. This is one of those FOMO buyers that thinks the market is probably breaking through a high, and he thinks he's watching the news, watching the general narrative, thinks it's never going to end, right? Says, yeah, sure, I'll take. I'm trying to buy everything I got. Okay, so that transaction is made. You in the middle made a profit. But again, notice the evolving opinions. You have one guy that says bull runs over. That causes him to act, to say, I need to get out of the market. Then another guy has to come with a different opinion, the polarizing opposite opinion, and take that inventory from him. And then they have to also exit. So there's kind of a stacking that happened here. You had one guy that thought the run's over. You have you in the middle that think, no, there's still some life left. And then you have another guy that needs to come in on top of you. That's how trends work. There's always got to be someone willing to take the next price up, right? So what happened here? 100 shares of inventory accumulated by the trader. That went into a holding period. And then 100 shares of inventory distributed for a $500 profit to the last buyer. So that's the cycle that happened here. And the guy in the middle made money. Your single biggest job as a trader is to consistently make quality market forecasts, accumulate discount inventory, and then sell that inventory for a profit. You're the guy in the middle. So you need someone that is willing to give you liquidity, or that you're taking advantage of the liquidity of them changing their opinion of the market. That has to happen. You're the guy in the middle, but you also have to anticipate that there's going to be people coming in above or below you, because you're going to need the same exit liquidity. Same as the banks. You have to think beforehand, am I going to get exit liquidity? That's how you make this a repeatable cycle, a repeatable process. And you put yourself in the middle right there. This is why trading in a directional bias is so important. Because we know that when the higher time frames are supporting the side of the market we're trading, that we are highly likely to have those buyers come in above or below us, or the sellers come below us, the buyers come in above us. That's likely to happen because it's getting supported by the higher time frame direction. Without that exit liquidity coming in, then we're done. We're stuck holding the bag. So it's super, super important you think of the markets as that you need to position yourself in the middle. You're sandwiched in the middle of these multiple transactions that need to happen. The way that we do that safely with the methodology is that we understand where fair market value is. We know that if the trend is long on the higher time frame and we are buying below fair market value on our lower time frame, chances are markets will revalue to where it has been agreed on in the past. And that is our first initial price point to get exit liquidity. That's where we're trying to sandwich ourselves when we're trading under value in an uptrend. We're sandwiching ourselves in between the people selling the market below value against the higher time frame, and we are forecasting that we're going to get at least a few sellers coming in above us for exit liquidity, even if it's only revalue going back to value. So keep that in mind. Okay, that's the whole purpose. So when someone doesn't follow directional bias, when they decide to ignore that, they are making the ability to put themselves in between this transaction that needs to happen. They're taking the probability of that happening out of their favor when they ignore directional bias. This is also another reason to trade in established trends. You don't need to pick the highs or the lows. You want to get something out of the middle. The more times you can effectively insert yourself in the middle of this process, the better you're going to do. Your entire job is to do this repeatedly. This leads to, you need to do an industry appraisal when you're getting into this business. Who is the best at accumulating and distributing inventory and that is the banks. We want to mirror what they do because they are constantly sandwiching themselves in the middle of this process. It's the only way to make money. They do it in market making and they do it in proprietary trading. In market making, they take a spread. They have a guaranteed profit because they're marking up the price, right? In proprietary trading, they're going from essentially pain threshold to pain threshold. Somebody's making the wrong decision. They accumulate their inventory from that, and then they're counting on that as the prices go the other way, they're going to have other people coming in that they can use that exit liquidity. It's always in the middle is where the profit can be made. So you need to have your approach needs to take that into consideration as the main thing. How do I get in the middle and facilitate trading the same way as the banks do? Your entire process needs to be around that. So the never-ending business cycle of the banks, just to illustrate this further, banks are accumulating sells, price moves down, banks start distributing those as buy orders and starts taking profits. Price will then go into a consolidation, starting the three market phase is over. Banks start accumulating buys, price moves up. Then the bank starts distributing those as sell orders and taking profit, and price goes back into consolidation. You could think of it as a constant, continual circle, market cycles. A lot of people will see this like as supply and demand zones. You have supply zones at the bottom, demand zones at the top, and then the price moves in this wheel-like motion as price goes up, goes down, goes up, goes down. So that's how you want to look at it. Inside of the middle of that is the weakest traders serving as fuel. The weakest traders are trying to call the tops and bottoms. They're selling breakouts, buying breakouts, doing everything wrong because the simple fact is that they're not looking at their business from this standpoint. That's the problem. They're not putting themselves in the mind of who controls the market, who's able to push it around, and how do they do that? How do they run their business? And it's all about being a middleman. It's about being a middleman and understanding where the discounted liquidity is coming in and forecasting future exit liquidity. If you can't put those two things together, you don't have a solid trading plan. The way that we do it, again, with ATS, we look at a higher time frame directional bias, we look at the flow of the overall money, and then we position ourselves according to fair market value on the lower time frame in the expectation that we're going to be able to make that little bit of distance coming back to value to put us in the money so that we have options and can. This is the cornerstone of a repeatable strategy because you're mirroring what the banks do. What's the takeaway? This is not your business. That's another big thing. A lot of traders think that it's my strategy, that I'm going to figure this out. I'm going to come up with my own formulas. Your formulas do not matter. This is not your business. You do not influence the market. So you have to align yourself with how the people that do influence the market, how they run their business, the tactics they use, everything, and you need to mirror those tactics. That's what puts you in that repeatable cycle to where you're not the fuel. You're operating in sync with the banks. So that's the most important thing that you need to get your head around. You are a participant in a much bigger game between world banks and institutions. If you want to operate successfully, you need to study why and how they move price. So that's the first lesson. And again, it's pretty basic stuff. This is where it starts, is getting your head around these basics. If you guys look at everything that you do from this standpoint, you will find that you have a much more effective approach to the market overall. And you won't get lost in all the other minutia that everyone else is looking at. That being said, that wraps up this lesson. Do you guys have any questions about this? We could open it up. Supply, demand, anything related to this. Go ahead. I'm going to unmute you, Marion, and if you got a question, go for it.
Hey, can you hear me?
I could hear you.
All right. This is great information. I'm so happy I'm here to listen to all this. I have a question though. Does this apply only to Forex? Because you're talking so much about the banks, institutions. What about other equities? Let's say Walmart, when you buy sell shares, does this apply? Because we know there must a pattern happen in all this price movement if there is enough of it. Are we still involving banks and bigger players in this, or?
Yeah. Anywhere, because the biggest problem for the bank is liquidity. So they're going to gravitate towards highly liquid markets because they can essentially deploy more capital and make a bigger return. That's why the banks don't mess around with like penny stocks. You have some lower level. There are probably departments in the banks that deal with that, some of that, but overall, there's just not enough liquidity. There's not enough people willing to transact in that market. So, you're not going to get as much bank activity, but like bigger equities like Amazon, Apple, things like that, they're definitely going to be interested in those markets because, billions of dollars are changing hands, in these different assets. So they're going to go where the liquidity is simply because there's more people willing to transact. The more people willing to transact, the more money they can take from those people. It's all about liquidity. The bank's biggest problem is when they have hundreds of billions under management or more. How do they make a return on that? And so you need to seek out markets that have a lot of transactional volume to be able to deploy that capital and make a return.